Welcome everyone to the Associate Profitability Workshop. Really excited to have you all here. I'm going to go through a couple quick housekeeping items before we get started, and then we will roll into our content. You should all have the option to submit Q&A at the bottom of your screen. We won't be going through Q&A on the call because we have a lot to cover. We want to be respectful of your time. So you can submit any Q&A at the bottom. We will reach out to you directly after the webinar and answer any questions that you have. If you have technical difficulties, you can drop those in the Q&A as well. Before we get started, just want to introduce ourselves. Tuatera is a strategic finance agency. So hopefully you guys have had some exposure to us being here today, but if that is new for you, Tuatera is really sitting at the intersection of dental practice departments. So your marketing department, your operations department, your accounting department, all come together strategically through finance. And that's where Tuatera sits to help support strategic decisions using the lens of finance that brings all of those factors together. Finance inside of a dental practice may be something you all are familiar with. For some smaller practices, you may not have experienced finance before. But as we shared in the Venn diagram, Tuatera sits in the middle of the intersection of all of your other departments. So finance is really an objective way to support strategic decisions. So you'll hear us talking across a whole lot of different types of content. So really, there's not a place that finance doesn't touch inside of your practice. Some of the things you'll hear us get really passionate about, among others, include the brand position and growth strategies for practices. Purpose-driven partnerships is a really big deal for us right now. I'm really enjoying doing that work with some practices. PPO and pricing power, that's always a hot topic in dentistry. Office manager elevation is another one that is really relevant right now, as well as compensation mechanisms and bonus plans. So we're starting today with this associate profitability webinar so that we can kind of, one, show you how finance works, but two, really answer a lot of questions that we've been seeing in the industry, in forums and at conferences and conversations that we've been having to help define this for you and for your practice so that you have some objectivity, again, that finance brings in strategic decisions. Before we go any further, I will introduce myself. My name is JJ Littrell. I am one of the co-founders of Tuatera and really happy to have you all here. I have been in the dental industry since 2017. My background started in accounting and finance in hospitality and healthcare, and that has been through startups up to Fortune 500 companies, as well as some consulting with major accounting firms. So I do have CPA at the end of my name. I try to hide that sometimes because oftentimes that means family members call with tax questions. That's definitely not how I've used my license, but I worked hard for it. You guys can appreciate that. So I do like to keep those letters around. I would like to turn it over to Brandon real quick and let him introduce himself as well before we get into the content.
Thank you, JJ. Hi, everyone. I'm Brandon Culp. I am the other co-founder of Tuatera. I have been in the dental industry this is my 10th year now. Amazing to say that. I never would have thought I would be in the dental industry, but I think like so many of us, I'm super thrilled to be here and passionate about it. My father-in-law was a pediatric dentist, and so that exposed me to the industry and some of the things that were happening. And so ever since then, I've been on this great journey. Prior to that, I had about 10 years in Fortune 500 at bigger companies similar to JJ, variety of roles in sales and marketing, finance, and operational finance. And then before founding Tuatera and the preceding firm, I was in a top 40 CPA firm. That's actually where I met JJ. So she didn't mention it earlier, but we've launched Tuatera, became official as of January 1st. So I'm really excited to do that together. And then I suppose, and the audience here will understand this since your educational backgrounds, I'm a glutton for punishment. I love to learn, both the certified management accountant and a CPA, as JJ said. And that gives me hopefully a unique perspective in some of the challenges, finance challenges, and bridging that accounting finance area that JJ showed you earlier. So real excited to dive into with you today.
Thanks, Brandon. So today's objective is to have a clear framework to determine the financial return on investment, or ROI, for adding an additional doctor to your private practice. In layman's terms, or in short, will adding an associate actually make you more money? So we hear a lot of conversation around this and a lot of misinformation around how to actually do this calculation and how great or not great it could be. And the answer is, of course, as every accounting and finance answer is, it depends. So we're going to walk you through today what this looks like for your practice. So, first thing we're going to talk about is adding another doctor to your practice a good idea. We're going to talk about that subjectively as well as objectively. We're going to go through a detailed financial analysis walkthrough. So, there is a template that was sent out with the Zoom reminders for this webinar. If you haven't had a chance to download that, or if you didn't see it, there's a lot of information in those reminders. We will be sending another link after this is done where you can download that. If you have it with you, you're welcome to go through it with us, but you can also go through the replay and walk through your financial information with what Brandon's going to share. And then we'll talk through next steps. Once you have this information, what do you do with it? We'll help you with that as well. So we're going to jump right in. So pros and cons, subjectively speaking. So this is really personal for each dental practice, for each dental practice owner. This is a very personal decision. So spend time on why you might want to bring in another associate. This is not something that we can help you decide on today, but it is something that we do think is critical for you to spend time on. So much so that we'll even say it's more important than the objective conversation we're going to have today. So there is not a number in the world that will make this work for you or not work for you if subjectively this is a good or bad decision for you. So this may be something that you need to do for personal reasons. This may be something that you want to do because you enjoy having, other doctors in your space. There's all kinds of reasons why or why not. So we will actually tell you that for this topic, you should be talking to other doctors, not consultants. So there is a reason why we're going to be together today for about an hour, and we will only have one slide on your why, but we told you it was the most important. The reason is we can share with you all day long a lot of great benefits of having an associate in your practice, but only doctors can share the reality of what that looks like. How does it actually look like moving around a practice with another doctor? What does it look like to trust another doctor with your patients? What does it feel like to have another cook in the kitchen, if you will? Only other doctors can share that reality. So while we will give you the objective measures today, we really encourage you to seek subjective opinions from others that you know, like, and trust. So first thing you'll do is make this choice subjectively, and then you'll add this objective calculation to that conversation. We're going to spend the time today assuming that you've already had this, at least a good idea that you're considering adding an associate. So we won't be spending any more time subjectively, but just want you to encourage you, go back to your why, go back to subjective decisions before you spend too much time objectively. Because again, there's no number that will make it work or not work for you, depending on what your why is. So now we'll get into objectively speaking. So there are many nuances and variables for your particular practice. This is why it can be true that you have friends who have, who will say that adding an associate made them a ton of money in their practice. You'll hear horror stories of how adding an associate, almost made somebody go broke. And both of those can be true for them and also not applicable for you. So this is where we want to be able to use your information for your practice, your goals, your situation to do this calculation. So we're going to use objective measures, not opinions. We're going to talk you through what kind of information you should be bringing in from your operational data as well as your financial data so that you can have an objective lens on this important decision. There are multiple scenarios that you may be in. So some of those to think through: a solo associate. So perhaps you have a location where you won't be practicing, but you'll be bringing in an associate. Incremental expansion in an existing footprint. This is probably the most common that we see, where maybe you have 4 ops and you want to expand to 6 or 7, making some changes inside of your current footprint. Or a major expansion. So this may be buying out a suite next door, moving upstairs, taking the practice and moving it down the street. That can be another way that you approach adding an associate. So we are going to go through a detailed analysis that we're going to walk through. Again, the template is available for each of you. Brandon will walk through it today, and then we'll be sure you get access to that if you don't have it already. Our model is super flexible. So for today's example, we're going to assume a small expansion. This is where the owner is going to slightly step back from 4 days to 3, and we're going to expand from 4 ops to 7. This just gives us a way to show you the way that this framework really works. This is a very common scenario that we see, but your scenario does not have to be the same. The framework will still work and the model will still work for you. Just wanted to give you guys a little bit of framework of what we'll be doing today. Biggest key here is that you want to leverage high quality, timely financial and operational data. So what we have found is the more comfortable you are with your financial and operational data being up to date, accurate, the more comfortable you are with seeing these numbers on a regular basis, the more confident you can be in using these numbers for decisions. So we will be going through this format today using Tuatera reports. You may be familiar with these if you're in our reporting system already. If not, any of this data that we're pulling should be information you can get from your accounting team if you guys use any kind of data analytics program, from your practice management software, et cetera. So you'll see us using Tuatera reports. But for us, we just want to really drive home the point that high quality and timely information is key to get you comfortable with the data so that you can have confidence in where it takes you. So with that, I am going to flip it over to Brandon, and we're going to jump into the meat of our conversation today. So Brandon, you can take it away.
I'd just like to reiterate what JJ was mentioning there for the group, that it's just really important that you have comfort in your current numbers. It can really feel like an insurmountable task to evaluate an expansion when you don't have the clarity as to how you're doing today. So even though we are going through the template that you now see in front of you, you should see in front of you. And again, this went out, so you should have a chance to download this. If not, it'll be resent out afterwards. We're also demonstrating the clarity and confidence you get when you can draw upon your current numbers. As JJ said, we are going to use an example, a very common one of practices looking to go from, say, 4 operatories to, say, 7. I want to make one more note before we dive in, and that is that the model that we'll be walking through is evaluating the project or your expansion opportunity on a long-term basis. So when we think about making these decisions, almost always when you make a major change in your business, such as bringing an associate or expansion, there's going to be a startup phase. There's going to be year one, and we're going to need a really specific plan on that. We're focusing first on what does this look like financially long-term, and we want to check that box first. And only if we feel good about that long-term, then will we start to consider the first year and what might be different about the first year in terms of the startup and the specific plan and action steps. So again, know that this would be a starting point to evaluate, does this project float financially long-term? And if so, then I would start the next phase, which would be, what does year one look like? And how do I create a compelling opportunity to track this associate? So now we're going to dive in, and we're going to simply begin at the top of this worksheet. We're going to work our way down. So we're going to start with, in this example again, of going 4 operatories to 7 operatories. What kind of production, additional production, might we be able to achieve with this? First thing I'm going to do is jump over to our quarterly financial report, or our QFR, as we affectionately call it, to give you an idea of what a reporting member of Tuatera might be looking at when considering this decision, and how it might come about. You're looking at our capacity schedule here, where this practice has the 4 operatories that we mentioned. And based on their brand position and their schedule and their procedures and other choices they've made in their office, we've estimated that their capacity might be around 1.5 million in production. They're currently doing 1.5 and change of production. So for all intents and purposes, as the gauge over here illustrates, they've really maxed out the opportunities from a production standpoint in this footprint. So they begin to think, well, how do I take the next step? How do I capitalize on the strong patient base I have and my hygiene schedules, booking out 4 months, 7 months? How do I get myself out of the chair as part of this? And it just so happens that the landlord of my building has let me know that the suite next door is available, and I could knock down a wall and probably get 3 more operatories in there, and maybe expand the lobby. And I want to take a look at that. So that's what we're going to do. So we would then work with our member to show them what their hypothetical capacity could be in 7 operatories. So here's that same graph with 7 operatories now. We tweaked the production per chair a little bit. This is an annual number, this 350 right here. Again, the senior doctor maybe is going to step back a little bit. And we know that when you put 2 doctors into one space, usually there's a compromise of maybe one doctor only gets 1 chair one day and then 2 the other day. So we want to be conservative as well. Now our little gauge shows that the current practice is only about 60% of what this expanded practice could look like. And we have an incremental or additional revenue opportunity of $917,000 in production. And if we assume a traditional split or the split in our office of about 30-70 between hygiene and doctor, that's about 275,000 of additional hygiene. I think it's a little more than one hygienist and change, and $650,000 a year in doctor production. We're going to take these numbers and we're going to take these now into our model. So the first thing that we've done is we have comfort that the production that we're assuming, this 917, is something that can be done in our facility. And as I said, we're going to use a 70-30 traditional split. So we now have the same numbers in our analysis template that we're used to seeing in our quarterly financial report. I want to make a quick note because what we're doing here is we're evaluating the project first. So we're going to evaluate the project first. And if we have financial viability on the project, then we'll start considering again that year one plan and maybe how the senior doctor pushes some production over to the junior doctor. So right now, I'm only going to focus on the incrementally additional production. If I need to hire someone that needs a $750,000 a year opportunity and I need to, as the senior doctor, push over another $100,000 of production, I will handle that later once I know the profitability from this project in total. Now we're going to spend time, because it's your biggest expense in this project, outside of if you have to do a major expansion, the associate's compensation. So we've really built this out so that you could be detailed in what you might offer an associate. Also, one of the big benefits of doing an analysis way is we can see really what we can afford. Because if we have a very profitable opportunity, then we can get more aggressive than our competition and maybe what we'll offer in terms of benefits and pay, which gives us a recruiting advantage in the market. Typically, in the private practices that we support, associate compensation is about 30 to 33%. I'm going to start out trying to be as aggressive as I can to see what I can afford. So I'm going to go ahead and put 33% here. The model's going to go ahead and do the calculations for me. So this is all pre-built. And over here, you'll see that we have inputs and references. So once you populate that 33%, it's going to do this math for you. Also over to the right, if you really want to dial this in, you can consider your payroll tax phase outs. For most of you, you could just ignore this. But if your project is really cutting it close, or you just really want to operate with that precision, you could get specific about your state's unemployment, for example. But most of you can probably just leave that. Next, I want to consider if I'm incorporating lab reductions or any other reductions. So here we're going to go and we're going to leverage our quarterly financial reports again. So I want to go ahead and create some alignment with the associate, and I want them to pay their share of the lab fees, which is about 33%. So what do I put in here? You might know that number. If you do, you can input that. If you don't, and what I'm going to do is I'm going to go back to our QFR, where another schedule that we present our members with are their supplies and lab details on a quarterly basis, how they're doing compared to last year, to benchmarks, and to where they're spending their dollars with suppliers. In this example I'm looking at, the practice is actually spending about 9% on lab, but I know that I'm spending a lot on Align Technologies. The current owners had an emphasis on growing Invisalign cases, but that's not what I'm planning for this associate. Actually, it's part of my strategy as the owner that I'll continue to focus on Invisalign. This person will focus on bread and butter. So I'm going to go ahead and put this in at 7%, okay, which even last year when I was at 7.2%, I was doing some Align Technology, but I want to be conservative. So I'm once again, even if I'm not using exactly the number that's here, I'm able to draw upon the information I have to feel confident that the 7% I am using is an appropriate number. So put that in here and it's going to automatically calculate their reduction. In the interest of time, I'm going to skip these next two lines, but we've just built this out that if you have more reductions that you've put in your compensation, you can go ahead and load that up. For me in this hypothetical, so we'll end up paying the associate about 30% of their overall production. Got my payroll taxes calculated automatically. Next, I want to consider if I'm offering a retirement match. We see a mixed bag on this. Again, so we give you the flexibility. In our case, I want to be conservative. I think it gives me a recruiting advantage if I can offer a 3% match. So I'm going to go ahead and do that. And then I'm going to consider the rest of my benefits package. Might have to do some math over to the side or in another spreadsheet. But I let them participate in our health insurance, and the company contributes. I cover malpractice insurance. Maybe I have a continuing education stipend. I'm going to add all that up. Again, your goal right now is to be conservative. I'm putting $15,000 in here. So I have a total associate compensation package just on this incremental revenue of about $225,000. Again, if this project floats incrementally and I need to make this 250, I'll find a way later to increase the associate's production, and I'll pull that out of my owner production using my owner profits. We're going to continue now with staffing, and we're going to move on to our next provider, and we're going to move on to hygiene. When you get into adding staff costs, this is really where having confidence in your numbers can come in, because often in the dental industry, we benchmark, we use percentages a lot. And when we do that, sometimes we mix up how to think about fixed and variable expenses. So we built this template in a way that will help walk you through that. So what I'm going to do when we add hygiene, and you'll have to determine if this is an appropriate assumption for your opportunity or not, but often I can add a part-time hygienist. Maybe I can get maybe I have someone that's working 3 days that would bump up to 4. Maybe I have someone at 2 that can go to 3. Maybe I can recruit someone doing 3 and someone doing 2. There's a good flexibility in that market. So what I'm going to look at, and I'm going to go back to our QFR to do this, is I'm going to look at the current ratio of hygiene production, net production to expense in my practice. So this is another schedule that our members receive as part of the QFR, where we look at staff departments and the percentages of revenue relative to last year and relative to benchmark. Again, for hygiene, because I think I have this mixed bag of variable and fixed expenses, I want to use this ratio. And so this ratio, once again, tells me for every dollar I spend on hygiene wages, what am I receiving in hygiene production? And I'm running at about a 2.5 to 2.6. As the benchmark shows, and many of you are probably aware of this because we're a very, again, heavy benchmarked industry, we'd like that number to be 3 to 1. But if I just use 3 to 1, because that's what it's supposed to be, but I haven't demonstrated that, that's once again where I could be too aggressive with my analysis and end up upside down or not getting the financial outcome I want. This allows me to feel good about the assumption I'm going to make, which is 2.5. So I'm going to take that back and I'm going to put that here. And when I put that ratio in, it's going to tell me about $110,000 in hygiene wages. Depending on your market, again, that might be, I need a full-timer and then I need a day a week somewhere, and I could think about, do I think I can get that from my current 2 hygienists? Can I recruit for that? In the event that that doesn't work for you and you think that number needs to be 150,000, you would, the way the model is set up, you would need to come over here and play with this. Sorry, I went the wrong way. And play with this ratio until you get the number that you're looking for based on how we design this. But I don't want to also be too conservative, and I would like to get to that 3 to 1 ratio. So I'm going to go back to the QFR and I'm going to look for one more thing, and that's if I have any opportunities in my current scheduling. And so one of the things that's calculated for our members is a schedule utilization number, the current appointments per hour relative to benchmark, and if I just have holes in the schedule. So I'm not asking for any procedure differences or pricing PPO, but just let's fill the holes in the schedule we have. It'd be nice if I'm going to spend 6 figures to expand the practice. Doesn't seem like too much of a stretch to ask the team to help me really fill up the schedule. And I notice if I do that, then that should save me about $20,000 a year. So I can go ahead and I can put that in here as well as an offset to my expense. And so maybe I only need about $90,000 in total hygiene compensation. Again, if I think that's not quite right, I can always take that out depending on how conservative, aggressive I want to be, but I'm going to keep that in here for now. That concludes hygiene, and I'm going to look at now my assistants and front desk. I want to take you back to our QFR to show you the mistake that most people or many people make when they're doing this, is they would add they'd say, well, I'm at 7% on my clerical and I'm at 4.5% on my assistants, and so I'll just use those ratios. We're not going to do that here because we believe in this particular example, adding front desk team members or assistants would be more fixed in nature. So I'm just going to think about the cost increase, whether that's hiring new people or asking existing team members to work more, and I'm going to put that in here. In many practices, the typical assistant ratio to dentist is 2 to 1. So I'm going to put in a cost here of $90,000. I think I'll have to hire 2 new people around $45,000 a year. And then on my front desk, I think with the additional volume from the associate and the additional patient flow and the phone calls and the follow-ups, I'll need another person at the front desk. And I estimate my total cost is about $55,000. Good rule of thumb for you, if you're thinking about your total cost, might be to take your gross salary and add 20% as a way to proxy payroll taxes and other benefits that you might offer. Of course, if you have this worked out on a spreadsheet, even better. That concludes my staff section. So one thing I want to point out, models calculating, I'm going to spend about 25% of this incremental revenue on the associate and about 25% on the other staff members. That happens to be in line with my normal ratios. I'm feeling pretty good so far. Now I'm going to work on my non-staff costs. And I'm going to start with my variable costs. So something else, again, a theme in a lot of our reporting is what's fixed and what's variable. This can be difficult sometimes. It's not an exact science necessarily. Tuatera's reporting and accounting system is very deliberate about separating variable and fixed expenses inside of the profit and loss statement. When you merge those together, you lose the ability to do what I'm about to demonstrate. So in our reporting and our accounting model, we know that we have variable and fixed separated. I've listed some major categories here that are normally the lion's share of the variable costs, which are my clinical supplies and lab, my credit card merchant fees, office supplies, but I'm not including like office expenses. I'm not including monthly software subscriptions that don't change no matter the volume. I'm trying to capture those things that only change with volume. I'm going to go back to the QFR. And in this case, I'm using the 7-share version that we looked at earlier. The quarterly report is already doing this for me. It shows me on a quarterly basis what my variable expenses are. In this practice, they're estimated at about 17.2%. And the report is already adding up those accounts for me. If you don't have our reporting, you need to run a P&L, get a percentage of revenue column, and add those up. Again, the watch out would be if you have accounts that are mixed of fixed and variable, you might have to separate those first. So demonstrating here how easy we try to make that for you. Now I'm going to grab this 17.2, but I'm going to make an adjustment because if you recall from a moment ago, I had lowered the lab fees from about 7.2, or I took about 2% off. So I'm going to do that again here. So I'm going to put 15% in here. And the model's now estimated at $137,000 in other expenses. Again, I did that because the lab bill I'm expecting on this incremental production is a little different than what I have on my base because they won't be doing as much Invisalign as I'm currently doing. Now I'm going to be moving on to fixed costs now. That's really it for my variable costs. That's what often makes these projects beautiful, is that if I can leverage the fixed cost base and I don't increase the variable that much, I can get a strong financial return. I mentioned in our example that landlord has let me know that the suite next door is available, and they'll give me first right of refusal for 30, 60 days or something to think about it before they put it on the market. The current tenant just let them know. They've informed me that it'll be about an extra $2,000 a month for that space, so I've got to put that in for my rent. Then a little bit of a catch-all here. You may have a situation where I mentioned those softwares. You might say, well, as JJ has mentioned earlier, bringing someone into the practice, we'd like to have more data to think about how we can be on the same page. I need to be more efficient. I'm gonna introduce some new software as part of this as well. You'll have to determine what that is. In our model, I'm going to add an extra $1,000 a month for $12,000. And then finally, and we did this intentionally because as JJ mentioned, with Tuatera being a strategic finance agency, we live at an intersection that includes marketing. And this is one of the things that makes us really unique, is highlighting how important marketing is, especially when you're trying to grow. And often marketing is thought of as a cost in this industry, and we benchmark it for the purposes of pushing it down. It's really important to think about your marketing when you're looking to grow. It is very common in projects like this, as I mentioned at the start. I have pent-up demand. I've built this great reputation in the community. I've been a stalwart for 10 years. I have 2,000 active patients maybe, and my schedule is booking out for 6 months, and it just feels like I have patients for days. Well, you probably do, but often what we see is that your run rate will only take you maybe about 6 months. And once the new associate comes in and you work through that pent-up demand and maybe that excitement, you'll start to stall out because it's difficult for a solo doctor to have enough active patients to serve 2 doctors. Even if you drop back, that's 1.75 equivalent doctors. It's very difficult to build up that much pent-up demand. I also want to demonstrate that an unlock for you that because you're able to leverage your current fixed costs, you can often in an expansion project afford much more marketing than you might be thinking and that you're spending in your base. And so another important element here is to be able to think about your practice and an opportunity like this is my base and my expansion or my additional. And that because these costs don't change, I don't have to consider them over here. And I can have unique costs related to this. And then when I put them together, I want to see if this really makes sense. Very important as well to use a high quality, reputable firm. We're a little biased towards dental specific firms because I think it's really important to really understand the data that's available and the technology and how to integrate with your software and PPO strategies. If you don't feel confident in your current marketing relationship and are looking to be introduced to someone, let us know and we can help with that. Once again, my goal is to be conservative here, so I'm gonna put a rather large number in here. Ideally, one of your first steps if you're moving forward would be to connect with that marketing partner and have them battle test this assumption with you. But I'm gonna go ahead and I'm gonna put $48,000 in here. And I have this reference over here. So the model's telling me I'm going to spend about 5% of revenue, the new revenue on marketing. Now, for most practices, they would tell me that is a huge number. We're spending 0 to 1% currently, and patients are beating us down, the door. And it's true. And this is an example to draw upon what JJ was saying. Both of these things can be true. That I have no doubt today, many practices, because of their personal reputation, have more patients they can serve and they're spending next to nothing on marketing. And I know that if you brought an associate, you'll probably get 3 to 6 months of that continuation. And there's a good chance it'll stall unless we tell more people about you and your wonderfulness and your practice and these expanded conveniences with this new doctor in there. It is also possible, and this is where you get the marketing person involved, your marketing partner. We're only showing you 1 year here. It's very likely, though, that if I have to start at a $48,000 marketing investment, maybe I can lower that to $36,000 the year after that, and then 30, and I can taper that back off. But when I start this, I want to, again, be I want to be aggressive with my expenses so I can be conservative with my profitability in the analysis. That concludes my income and expenses and what's normally on my profit and loss and where a lot of people might stop. But you'll notice in our case, this gauge down here that hopefully you've already taken away, that's prominent and it's important, and we want to know what that's doing for us. How's that moved? So I have one more critical step here, and that is, well, I've got to lease the space next door. I've got to pay to knock down a wall. I've got to build out these operatories. I have to equip them. Maybe with another doctor, I need to buy a scanner. I'm going to have to borrow some money from the bank to do this. Maybe I have the money sitting around, but most practice owners don't, and nor should they, because we have plenty of banks that are willing to lend to the industry. So I want to consider my debt. So we have built you a loan analyzer over here. Very common that I might have 2 or 3 loans, a construction loan for the build out, and then equipment. So I'm going to go ahead and I'm going to populate these. So and this is where projects, as JJ was saying once again, really matters your situation. And that this project that might add $235,000 to my bottom line could, depending on how much I have to spend to unlock that with debt and construction, I could have 2 different answers for an identical opportunity based on the unique situations there. Sometimes footprints are really easy to expand and sometimes they're not. Okay. In our case, we've received a quote for $500,000. The bank has told us they'll lend at 6% for 10 years, which is 120 months. But we also are working with Patterson, Shine, Benco, and we need some chairs. We need some other equipment. They've told us that that'll cost us another $100,000. They'll give us a 5% interest rate. That's the good news. They're not a bank, so they want to be paid back in 5 years, which is 60 months. And then I have one more. I mentioned that scanner. I think it makes sense that with 2 of us in there and how we're using a scanner today, not just for Invisalign, but for diagnosis, I want to get another scanner, and that's going to cost me $30,000. Good news, they'll give me 3% rate. Bad news, they'll only do that for 36 months or 3 years. As I was populating my debt, you can see that my gauge has now populated. For those of you that might be using existing cash, because you want to evaluate all projects like an investor and an owner, you would go ahead and put 3% in here. Okay, so if you have $630,000 just hanging around, don't borrow from yourself for free. Go ahead and at least put in 3% for inflation. Of course, if you would like to evaluate even higher return, you can put that in. But I've got market rates here. So now my gauge is populated, and now I'm looking for guidance. Is this a project from a purely financial objective standpoint that I should move forward? We've built you a little legend down here as well. So let me back up a minute. Where does this come from? We are leveraging our understanding of how banks evaluate projects, kind of return on investment we know our clients are looking for when they take on these risks. The fact that our assumptions aren't perfect and year 1 might have to be different. We have to pay taxes, so our silent partner, Uncle Sam, always wants his cut. So if my return is too low, all of it goes to taxes. Like, what's left? What's it all for? So we've color coded this and given you some ranges, and it's very much like a stoplight. So I'm gonna start with the yellow because that's where we are. Sometimes when you're in the yellow, if you're closer to the orange, that might be, ooh, I should proceed with some caution, and maybe I really need to have some good strategic reasons for doing this. As I get beyond that midpoint, I'm good to go. So in this case, at 14.8%, this is a pretty strong project. I should have no issues getting a loan from the bank. This model also lends itself to a plan that I can talk to the bank about that I have in ramping up the practice and give them some extra confidence as well in lending to me. When a project starts to get around that 10%, so if I was in the orange, and I'll show you what that looked like if I had to spend $750,000 to make this happen, starts creeping down. I'm probably still okay, but Let's say it was 900,000 because my footprint is challenged. Now I'm in this orange location. I should probably only do this if I really want this for work-life balance reasons or some other strategic component. I'm not getting a strong financial return. The bank will probably still do it around here. But if it keeps going, the bank would probably bow out. So just to show you what that looks like, if I have to spend, oops, 1.5 million on this project or 125 because the footprint just doesn't work well, underneath that red, the bank's probably not going to give us money and we should abandon the project. The orange and the yellow area is where this gets trickier. Oftentimes, in the orange area here, the banks will give us the money because the banks use a different standard for paying off debt versus thriving. Okay. So that's why we have a goal here that when you're in the orange, really consider if you have enough strategic impact. When you're in the yellow, you are typically good to proceed. And then just to show you, because sometimes it happens, maybe there was another dentist in this space before that's retiring and they've already built this out for me and I just have to update it and I could do this for 250,000 or something like that. Now I have a really strong project and it starts to get closer and closer to a no-brainer. Sometimes even you'll see that somebody else tried to expand a project and it didn't work for them and you have to spend even less. And it's just a financial no-brainer at that point. That's why we started, once again, the way that we did was that we don't want you to think there can be any number to just pursue this from a financial basis only. This all assumes that you've checked the box strategically, and this is something you want to do for strategic, qualitative reasons as well. But hopefully, as we walk through how you can use this end piece, you now have a framework that regardless of your project, you can analyze for that long-term profitability, and you can even consider the debt that you'll have to take on. And with that, and with the comfort on the numbers you've used, you can then take the next steps in your project, such as scoping out a year one plan and thinking about the changes you'll have to make, talking to a marketing partner, and starting to bring that to life. So to that end, I'm now going to kick it back to JJ, and she'll tell us about next steps.
We just went through quite a lot of information. We tried to go quickly again to be more illustrative and allow you guys to do that on your own. But once you've been able to get this template in hand, we want you to do your own analysis. So drop in your information as Brandon shared. The nice thing is this is a template you can play with. So as Brandon shared, you can say, well, what happens if I spend twice as much on construction? What happens if I don't have to spend anything on construction? Most practices are not in a space where they have all the ops just sitting there ready, plumbed to go, and they just have waited to bring on a doc. Usually there is some investment that has to happen there. So you can use that. You may need to get drawings, quotes, as Brandon said, battle test some of these assumptions with marketing partners, equipment, construction, etc. Then the next thing you'll want to do is take these results to a trusted advisor. That might be your CFP, your CPA, other consultants that you work with. Most important thing here is to get confidence in this information so that you can prepare for the next steps. So any model is only as good as the assumptions that are into it. So as Brandon shared, if you have a percentage that goes up or down by a few points, or you have debt that goes up or down by 50, 100,000, that really can change what the outcome financially can be. So assuming you have the subjective conversation, you want to move forward, really, really important that you take this now to somebody that can help you battle test it. A shameless plug here, if you don't have someone, Tuatera can help. We know that sometimes these are unique circumstances where you need a different resource than maybe you already have in your stable, and we would be happy to be that person for you. So before we go, I mentioned it before, we are going to send the link to this video along with the template that Brandon just went through, and that will go out to all registrants. In addition to that, there is information about the deep dive consultation as well as the membership will be included there as well. And we'd love for you to tell a friend if this was valuable to you, if you felt like you got to see numbers and finance in a different way. We are going to be doing more of these presentations. We would love to have you share this with other folks in your community. And we'd also love the opportunity to see you again in another webinar.